So what if you could pinpoint the exact moment a runaway market is about to slam on the brakes and reverse? Well, today, we're diving into a really powerful trading tool designed to do just that, especially when prices get pushed to the absolute extreme. It's called the crab pattern.
You know the feeling, right? We've all been there. You're watching a price just scream in one direction, and you're thinking, okay, where is this thing finally going to run out of steam? We know reversals have to happen, but the million-dollar question is always, where?
To really get the logic here, let's use a super simple analogy. Imagine the market's price action is just like a rubber band. You can stretch it and stretch it, pulling it further and further away from where it started.
But you know what happens, right? Eventually you hit a breaking point. It's just too much tension, it's totally unsustainable. And when that rubber band finally lets go, it doesn't just go limp. No way. It snaps back, usually with incredible speed and force. The crab pattern is literally designed to find that exact snapping point.
So how does this pattern actually do that? Let's get into the weeds and break down how it helps us find that precise breaking point in the market. So, the official definition? The crab is a 5-point harmonic pattern. It was discovered by Scott Carney way back in 2001. And its whole job, its entire purpose, is to pinpoint potential trend reversals when a price move has gone completely off the rails.
And it comes in two basic flavors. You've got the bullish crab, which kind of looks like a stretched out M. This thing shows up at the bottom of a nasty downtrend and signals a potential snapback rally. Then there's the bearish crab, which looks like a stretched W at the very top of an uptrend. That's your warning of a potential and often sharp drop.
Okay, so how do we tell a real crab pattern from just some random squiggles on a chart? Well, it all comes down to its very, very specific DNA. The one thing you have to look for, the defining feature of the crab, is its final leg, what we call the CD leg. This isn't just another price swing. It's an extremely long, overextended move. This massive stretch is the key signal that the trend is just running on fumes. It's completely and utterly exhausted. And that point of exhaustion? It's defined by one very specific, almost magical number, 1.618. You gotta remember this one. This is the pattern's secret code. It's the Fibonacci ratio that acts as its fingerprint. So for a pattern to be a valid crab, it has to follow a very precise recipe. After that first big price swing, the XA leg, you get a little pullback. But here's the clincher. The one rule that is absolutely non-negotiable, the final point of the pattern, point D, has to stretch out to exactly 1.618 times the length of that initial XA leg. If it doesn't hit that specific number, it's just not a true crab pattern. End of story. All right, so let's say you've spotted a valid crab pattern. It meets all the rules. What do you do now? Let's turn this theory into a practical, 3-step trading plan. The whole strategy hinges on one key area on your chart. It's called the potential reversal zone, or PRZ for short. This is the spot where the pattern completes, where that rubber band is stretched to its absolute max, and where we expect that violent snapback to begin.
Here's the game plan. Step 1 is your entry. You only act when the price hits that 1.618 level, and ideally, you wait for a candle that confirms the reversal is actually starting. Step 2 is your defense. You place a stop loss just a little bit beyond that point. That way, if the rubber band stretches even further, you get out with a small, manageable loss. And finally, step 3, your targets. You set clear profit goals at key levels as the market snaps back in your favor.
Now look, as powerful as all this sounds, we have to be realistic. The crab pattern is a high probability tool for sure, but it is not a crystal ball.
Its biggest strength is its precision. I mean, that 1.618 level gives you a super specific entry zone, and the reversals can be incredibly sharp and profitable. But on the flip side, these patterns, they're pretty rare. They require exact measurements. And if you jump the gun without waiting for confirmation, you risk getting steamrolled by a trend that just keeps on going.
And it's also really important to know the difference between the crab and its cousins. See, other patterns, like the bat pattern, look for reversals that happen inside the range of a previous move. The crab, though, is an extension pattern. It's looking for reversals that happen far beyond the initial move. What makes it totally unique, even from the butterfly pattern, is that extreme 1.618 target. It is specifically designed to catch reversals from the most overstretched, most irrational market moves you'll ever see. So, to really up your chances of success, pro traders have a few key tricks. First, they look for confluence. Does another indicator, maybe like RSI divergence, also signal that momentum is dying? Second, check the higher time frames. A crab that completes at a major weekly support level is way more powerful than one on a 5-minute chart. And finally, and this is the big one, always practice strict risk management.
And all of this brings us to a final, maybe even a more profound question. What is it that actually makes these patterns work in the first place?
You know, at the end of the day, the reason this pattern works isn't some kind of magic. It's pure market psychology. These patterns identify points of maximum emotional exhaustion. That moment where the very last buyer has finally bought at the top or the last seller has panic sold at the bottom. And when there's literally no one left to push the price further, the reversal can be incredibly violent.
So what do you think is really going on here? Is this some hidden mathematical code that's hardwired into the markets? Or is the crab pattern just a picture of human psychology, a chart of pure fear and greed stretched to its absolute breaking point? The answer to that, well, it might just change how you look at the markets forever.